All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition. Hi, everybody. Welcome to episode 7 of Macro Corner, proudly presented by Blue Line Futures. I'm your host, Paul Wankmueller. The chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@bluelinefutures.com for a free trial. My guest this week is Jannis Meindl, and the topic that we are going to cover is central economic planning and economic conditions. We are going to introduce a new term to our listeners, modern monetary theory. Basically, modern monetary theory is the idea that governments do not rely on taxes or borrowing for spending, since they can print as much as they need and are the monopoly issuers of the currency. Welcome to the show, Jannis.
Hey, Paul. Thanks so much for having me back on the podcast. We got a lot of stuff to cover today. And speaking of MMT, Sri Lanka was actually the first country in the world to reference MMT as an official justification for money printing. So we know that what that's led to ultimately.
Absolutely. And I believe I read an article in Bloomberg over the weekend that China will agree to $4 billion of aid for that country of Sri Lanka. And we have been talking about that going back past couple of podcasts of how China is going to step in and lend money, possibly, crops, things like that to these emerging market countries.
Yeah, exactly. I mean, this is exactly what we've been talking about over the last couple of weeks, where China becomes one of the most senior lenders in the debt structure. And when you look at various charts that the IMF publishes, for instance, then you can really clearly see that China is playing that more increased role. And we're seeing that right now with Sri Lanka, too.
We called it. I will start off with a little quote from Ben Bernanke. Setting monetary policy is 98% talk and 2% action. So let's dive right in here. We have slide 3, goes with slide 4. This is the fear of inflation spiraling in advanced economies. And these slides, one is advanced economies, slide 4 is emerging markets. And what it's telling me, or what I'm seeing, is that as companies raise prices for their products, it seems that other companies will rise their prices of their products just to kind of keep up with the other companies. Is that fair to say?
Yes. So what we're basically seeing with these two graphs, as you already summed up here, is that as inflation permeates through the economy, it sort of becomes the self-fulfilling prophecy. And that's ultimately the reason why people like Jay Powell are talking about a clock running when they talk about inflation, because as more and more people have that inflation mindset, everybody else raises prices. If the first business raises its price, then the second one will, then the third one will, the fourth, the fifth, and then you have basically that exponentially growing effect of inflation. Businesses, no matter what the input is, raising the price of those end products. So that's ultimately why, as inflation goes up, it becomes this sort of spiral that the Fed often talks about avoiding. They're talking about that within the context of wages too, but just solely focusing on inflation and how price changes become more and more similar as prices go up in the economy. As inflation goes up, all the price changes become more and more similar. And that just means that inflation becomes this self-fulfilling prophecy. And that sort of phenomena that exists is even more, expresses itself even more in emerging economies than it does in advanced economies, because as we've talked about in past episodes, you have things like the debt burden in currencies that are denominated in, say, dollars or euros, so they don't have that same control that other countries have. So that issue is even more profound in emerging economies compared to the advanced ones.
Sure. And, the emerging economies are quick to pull that trigger when they're adjusting their prices upwards. I mean, they are an emerging economy. They are looking to, advance themselves as quick as possible. The economies are a little bit hotter and colder at times. And if, I mean, going back to what you said too, if I own a company and my profit margin does not change due to inflation, if my input costs stay the same, but I'm seeing other companies raise their prices, I might as well raise my price also. I mean, the end goal for my company is to earn a profit.
Yeah, exactly. And I mean, that speaks to this inflationary mindset that becomes more and more prevalent in society as a whole as inflation goes up. Like you said, if you're a business owner, then you might as well raise prices while you have the ability to do so, because you can either justify it by an increase in wages or just by the fact that in the economy as a whole, inflation goes up. So, regardless really of what was the initial trigger of inflation, I mean,
Right.
in the instance of the COVID context, it was okay, we had supply chain bottlenecks. Then one thing led to the next, and you had shortages all over the place. But what we see with inflation is as prices increase, so the price of everything goes up, regardless of what the underpinnings of that specific good or service is.
Yeah. Yeah. I guess it's just, people are going to be more comfortable with it, and it's kind of, it settles in. It settles in it, in that spiral. Good stuff. Let's move on to slide 5, the wage price spiral. So this graph, this line for lack of a better word, shows how many different countries, or the share of countries, um, kind of link their wages to inflation. Is that right?
That's exactly correct. So you see that during inflationary periods, I mean, this graph goes back to the 1960s,
Hmm.
and then you, of course, have this inflationary time during the 70s and 80s, where more and more countries started to adjust and link wages directly to inflation, because it's a logical sequence of events. So if you are a worker
Hmm.
and suddenly you see that inflation is high, you will want to have your wage cover that increase in price that you have on your everyday spending.
Right.
So as inflation goes up, a lot of workers just demand their wages to be indexed to the inflation in the economy, and that also depends on how strong the labor union is and things like that. But basically, what this chart illustrates is, okay, as inflation goes up, you have wages being indexed to that inflation. So logically, the wages also go up. That means input costs for businesses go up, and that has vast implications for the profitability of businesses and companies, and then ultimately the stock price and how the profit margin is getting affected by the increase in wages. And it also connects to one really interesting dynamic, which is demographics, but we can talk about that a little bit more now.
Sure. About demographics. Yeah. So I mean, also, would you say this is a correlated to labor and union participation, or union participation rather? Because I believe when, in the 70s, that is when maybe it was peak or union participation rather, with the auto companies and the Teamsters and things like that.
Yes, that is actually, that point is spot on, because as we have seen over the last few decades, call it 40 years or so, we've
Mhm.
really seen this trend of globalization and capital really getting the largest chunk of the profits, whereas the labor component, say in the US, has not really profited to the same extent. You think of things like manufacturing chains relocating from Detroit to China, or you
Right.
have things like, I mean, auto manufacturing, all that sort of stuff. And what you see historically speaking is that as the gap between what capital earns, or what the top 1% earn and what the bottom 50% earn, as that gap widens,
Right.
unionization becomes more of a topic.
Of course.
Because, of course, if you are in the bottom 50% and you see that there is an unequal outcome, you'll want to have a fairer share of that capital. And ultimately, like you said, in the 1970s, with globalization not having yet started, labor unions had a much larger role to play, and that as those sort of were phased out in the process of supply chains relocating, that share of wages being indexed to price has gone down.
Right, right. Yeah, I see a little bit of an uptick here in 2017, but overall, it's been pretty flat in a downtrend since the early 90s. And going back to what you're speaking about demographics, tying it into here, what I'm looking at here is in the 1990s, China had a really young, vibrant workforce, and as time goes on here, 2015, it looks like the majority of the workers are in their 40s, and it's kind of inflating a little bit higher to the year 2040, going into the 60s, and I believe by 2050, this is shocking to me. By 2050, you're saying that the number of the population is expected to go down to 726 million of China?
Yes. So exactly what you've seen and what you've just spoken about is you have this really predictable variable in the economy, which is demographics. You
Hmm.
know how many people get born today, how many people will approximately pass away, and then you ultimately have a ratio that allows you to predict the trajectory of the overall population. And exactly as you've referenced, in the 1990s, you had this young labor force and this vibrancy in China, where you had a lot of workers come into the labor force, and that allowed other countries to come in with manufacturing and all that, and that overall dynamic where Western consumers were able to take advantage of a growing population in China. And in the fullness of time, that has completely turned upside down. So what looked like a pyramid in the 1990s, that demographic structure has basically turned on its head, and you have an inverse pyramid
Yeah.
almost right now. So the Shanghai Academy of Social Sciences is predicting that by 2050, the Chinese population is expected to shrink to 726 million people. And right
Wow.
now it's at 1.44 billion people.
Yeah. Yeah.
And what's maybe even more interesting is that they're referencing the fact that the Chinese labor force has already peaked. So
Right.
what we are having right now is that not only do you have onshoring, friendshoring, and a more independent supply chain and that inflation dynamic playing out, but you also have the fact that China's not even able to play that same role that they used to play, as less people are in the labor force, as the West cannot take advantage from that same labor arbitrage that they used to. So that sort of speaks to the idea of you have this wage price spiral, and of course affecting whether that spiral will play out or not is how much leverage the worker has in the West. If you, it's a basic supply and demand imbalance
Right.
question. If you have not enough workers, but the demand for the goods stays, then the workers have a lot more leverage. And that speaks to the fact that unions will likely play an increased role in our society going forward, because if manufacturing is brought back, then the workers who need to produce the final goods, which China used to do with even the intermediate goods that China used to produce, then the workers in the US and the Western world as a whole will demand more for the work that they provide. So it's
Right. But I
really
mean,
interesting with demographics.
yeah. Well, I mean, what's the outlier here, though? Outlier is AI and robots, and maybe you don't need. I mean, I've heard plenty of times that people spoke about this idea of, paying people not to work. Is that something that's going to be factored in the future? We don't know yet. And then you have to throw
Yeah,
in the possibility. Yeah, go ahead.
that's ultimately a question around UBI, universal basic income, and
Right,
whether
right.
that's going to be a thing, whether the robots and the AI machines are going to be so productive for everybody else not needing to work. I mean, quite frankly, though, this could be a similar idea to what we've seen play out with MMT. It sounds pretty good on the surface, but
Sure.
then you dig beneath whatever you see, and it's not that great. And you also have to acknowledge that, of course, there's technological progress, but when you think of things like doing the laundry and the fact that there's not a robot yet that can do it for you, really,
Right.
then you need to ask yourself, okay, call it the next 50 years, how much will we be able to rely on robots? Of course, industrial robots are a different topic, and I have no doubt that technology will progress and that there's going to be more and more work that can be automated. But at the same time, you want to be careful with how much of the blue collar workers you can really replace. I think it's less than most people might think.
And in addition, it goes back to the demographics that we spoke about, and coming, going forward, emerging markets are not going to be able to afford robots that do your laundry, and that's not going to happen. Unless Elon Musk comes out with a cyborg robot that's super super cheap. But I think that the demographics play into that as well.
Yeah, and speaking of demographics, actually, the U.S. is one of the really few countries that has demographics that are not as bad as all the other countries. So, in fact, the U.S. population is still expected to grow over the last 80 years or so, while other countries can't rely on and increasing their labor force. So this is really interesting, and that's, I think, also a reason why executives are increasingly thinking of relocating the supply chains and diversifying the risk of having supply chains in one place only.
Mhm.
Because if you have this dynamic where you have less and less labor in one place, then you will want to be reassured that your production will not come to a halt in the
Ah,
near or distant future. So there's
right.
actually a survey was done by UBS, and that basically talks about the fact that more than 90% of surveyed executives are thinking of relocating or moving out of China. So this is really interesting, sort of that
Wow.
diversification theme that we're currently witnessing.
And that would be, I'm just generally assuming Africa is the next stop for those supply chains.
Ultimately, it's also a question of skill. So it's not as easy as just relocating from one place to the next, because
Yeah.
skill is not as transferable as the physical capital is. So whether that's going to be Africa, it might even be more advanced economies where the wages are maybe higher, but the skills are still there.
Right.
So it
Right. Right.
also depends on what industry are you in, what sector are you in, and then you're going to make that decision. But it's interesting that we are moving marginally away from efficiencies to more resilient supply chains.
Sounds good. Sounds good. Great, great stuff. Let's move on to slide 6, and I believe slide 7 ties in, and then we'll roll right into slide 8 here. These are loan to deposits at U.S. commercial banks, and as I'm seeing here, it looks like the banks are not loaning out as much, as many loans as you would think, compared to the amount of deposits that they have. What I'm looking at here, it seems that we're coming off the lows here, but we are near all-time lows here, going back to 1973. As deposits are growing, the banks are not making loans. What's going on here?
Yeah, so basically this is diametrically opposite to what we've been talking about in terms of the consumer hurting and the consumer having to take out high interest loans, which is a topic we'll cover in a couple slides.
Yep.
But what we basically see here is that the loans to deposits ratio, which is just a way of sort of taking a look at how much leverage there is in the system on the consumer side and on the bank side, that that ratio is at a number of 0.63, and before the COVID pandemic hit, that was at 0.76. So we
Yeah.
have seen a step up of 0.13 here, and that just means that part of the consumer is still really well off, and that the credit in the system may not be as uh, large as people may suspect at first glance. So turning to slide number 7, we saw a step up in deposits minus loans of about $3.3 trillion
Hmm.
from the onset of COVID until the peak. We've come off of that peak by about $624 billion, but
Mhm.
still, all things considered, we are $3 trillion above that pre-COVID level, which is gigantic. And so what we want to have is we want to strike a balance between taking a look at the shape of the consumer and then also differentiating between the bottom 50%, which is of course hurting tremendously, amidst higher food and energy prices. But then you have that other 50% at the top 1% that has an extraordinary amount of savings and deposits at the banks compared to how much loans they have taken out.
Right. And those are just deposits that's bank. Would say my 401k be included in that?
Whether the 401k, I would think so.
Okay.
I don't know like the exact composition of the number, but that's
That's
just
okay.
deposits
Yeah,
versus
just a
loans
thought.
at the commercial banks.
Right. And it's like you said, that the top 50%, they have the cash in the banks. But rolling into slide number 8 here, the high interest rate consumer loans. So here we're seeing a spike up around 2010. And it seems like the trend is going from the lower left to the upper right, which would be an uptrend. And looks like in around around COVID, continuing on, like we said, the consumer loans and credit cards and revolving plans at higher interest rates are increasing for those lower 50%. So when you talked about the hurting consumer, maybe we should split this into two, based on either your income or your savings.
Yes. So this is basically the dynamic that we've talked about over the last couple episodes where we covered, okay, consumers hurting food and energy prices, and that's ultimately feeding through to higher credit card debt and all that stuff.
Mm-hmm.
So on the back of COVID hitting, we of course saw transfer payments and a lot of people were relieved by those. And we saw a step off from high levels to a lot lower levels. But from that bottom and highly expensive credit
Mm-hmm.
until now, we've seen about $140 billion of credit being taken out. And that's largely the bottom 50% of consumers who need to rely on high interest credit because the credit score is not as high and they just don't have access to loans that are lower
Right.
interest. So automatically they go to the credit card and they take out the loan there. And so this is just a thing where we need to be careful in differentiating between the bottom 50% and then the rest of the population. And the fact that there's a large gap in between those two people who, on the
Yeah.
one hand, have a lot of deposits left, and on the other hand, are really struggling. And so that flows directly into slide 9, where we see that the Fed wants to address financial conditions. And what they're basically doing here is they don't say it as directly, but tightening financial conditions basically means they want to destroy wealth. And one of the ways to do that is you want to bring down stock prices, you want to bring down the price of real estate. And that's the only way you can really address those people who still have a lot of deposits.
Right. So you're saying that the Fed is doing this, but they're not coming out. They're saying it by not saying it. They're doing it by not saying it.
Exactly. This is just a quiet part out loud, really, where you have the Fed speaking about tightening financial conditions, and all it really means is, I mean, they're pretty direct about it.
Yeah.
But what they're basically saying is, okay, we want to loosen up the labor market, which is extremely tight right now. We want to alleviate some of those wage pressures that we're currently seeing, and then we want to come in with a negative wealth effect, which means they need to destroy wealth in some form. And one of the best ways to do that is making the price of the assets go down. And assets or stocks, or bonds, or real estate. And only by decreasing the price of these assets, the consumer will basically feel less wealthy. And the hope is that they will pull back on spending as a result of it. And one of the really important factors to consider here is
Mhm.
they need to keep inflation in check, because if they destroy a lot of wealth in the stock market, but inflation stays high, then the consumer will still spend in the current time because they have an expectation that in the future the prices will be a lot higher. So you need to find that
Right.
balance between depreciating the price of assets and then bringing down inflation, because if you don't bring down inflation, even if you have a negative wealth effect, you won't really decrease spending.
Yeah. I mean, it's, if you think that TV is going to be more expensive next year, take out that 30% high interest consumer loan and go get yourself that TV.
Yeah, that's not going to work.
Agreed.
Yeah, I mean, like I said, they definitely have to strike that balance. And I'm not saying
Right.
this is an easy job, but it basically goes back to the topic that I wrote the article under, which is central economic planning. And
Mhm.
sometimes there are just much larger forces at play, especially when you create unsustainable conditions, which one would argue we have had for the last 2 years. And right now we're basically coming off of that disequilibrium, if you want to call it that.
Sure. Yeah, yeah. Going back to, the savings rates and, when the checks were coming out in 2021, we did see that blip as seen in chart slide number 7 of more money going into the bank. But here we're seeing that it's come back down to equilibrium, reverted to the mean. We're around 5 right now for personal savings rates, and gross savings are also coming in a little bit. And from what I understand, this number could possibly go negative if people are taking out those loans on credit cards and whatnot and using that to purchase things.
Yeah, so on the right side of this slide number 10, we're
Hmm.
looking at personal savings as a percentage of disposable income. So theoretically, like you just said, if you don't have enough disposable income, say your expenses are higher than the revenue, which is your job, things like that,
Hmm.
if the expenses are higher than the disposable income that you have, that number could theoretically go negative. And what we're
Right.
seeing is that we are really coming off of unsustainably high levels where you had transfer payments and people feeling extraordinarily wealthy and buying shoes at Gucci. And we're now just coming off of that disequilibrium here again. But what's important is that if you are coming off of that highly unsustainable level, then you will feel so much worse. I mean, if you are a
Right.
consumer and you suddenly have to step down from Gucci shoes to Nike shoes, even though those are not bad, then you will feel a lot worse than you did a year ago. And that's
Right.
basically another way of the Fed addressing that issue of high inflation and unsustainably high spending. Whether we will see a full shift back from durable goods and from goods spending to services is not entirely clear, but just looking at anecdotal evidence like the flight demand we're currently seeing. I mean, Heathrow Airport in London is capping the rate of daily travelers to I think 100,000 people. So
Really.
flight demand is off the charts, not only in the US but also in Europe.
Hmm.
So this is just a renormalization of things, and
Right.
playing a similar thing as we just discussed with the wealth effect.
Right. And going back to what you said about going from Gucci to Nike, from what I understand, with regards to behavioral economics, it is said that you will be a happier resident if your income level is higher than your neighbors versus if you have the smallest house on the block. In theory, like you said, your feelings might be hurt. You might not feel as comfortable.
Yes, for sure. I mean, this is sort of one of the really interesting fields, which is behavioral economics,
Yep.
where if you feel relatively less off, even though you're just returning to a level that you might have been at a prior point, then that's still worse than that prior point, and spending might still be less. So, yeah, it's really interesting.
Yep. Yep. All right. Let's go to inventories and sales. In today's economy, I think everybody knows that they're seeing the target earnings a few months ago, or last quarter rather. Inventories were way up after COVID. Everyone tried to, or all the retailers rather, tried to scoop up some inventory, and now they just have too much of it. So, are we going to see Black Friday sales beginning a month, 2 months early, so that these guys can unload their inventory off the books? Or what do you think here?
I mean, logically speaking, you would definitely expect businesses who have excess inventory to load that off via lower prices, and that's ultimately playing into the cards of the Fed, who's of course hoping that prices will come down.
Hmm.
Then there's this question again, okay, we've seen these really low inventory to sales ratios, which just means businesses don't have enough inventory. And that's why they ultimately ended up double ordering. And right now they're paying the price for double ordering. So it's sort
Right.
of going back and forth there. But yeah, of course, if you have a weaker consumer, which is reflected by things like the personal savings rate,
Yep.
and you have on top of that inventory levels that feel too high for businesses, then you will have prices go down. And so,
Mhm.
yeah, I mean, inventories have been at really low levels, but this is ultimately a normalization process.
Right,
And
right,
this speaks to the fact that the economy is still tight on the inventory side, but you'll have two things coming together. You have all these goods suddenly arriving that you might not need anymore because spending habits are at a much different level. And then you,
right,
of course, have the consumer itself in a much weaker spot.
right. Yeah, we'll see how that plays out. And going into slide number 12, and then I guess this kind of ties into what we were speaking about earlier with demographics. The U.S. labor force participation rate has been steadily declining here, I believe, since the mid 1990s. And let's talk about that a little bit in the U.S.
Yeah, so this is sort of what we spoke about at the onset of this episode, which is the power, for lack of a better word, is shifting back into the hands of the wage earners, back into
Right.
the hands of the employees. Because as you have deteriorating demographics in places like China, at the same time, you have supply chains relocate, and some of them will relocate back into this United States. At the same time, you have that dynamic playing out where the labor force participation rate is declining, which just means less people are either able or willing to work. Then the workers who are still in the labor force will have the ability to demand much higher wages. So this is
Right.
sort of one of the structurally inflationary issues that we're currently facing. And this is exactly opposite to what we saw during the 1970s and 80s, where you also had this high inflationary period, but you didn't have that same structural force. You didn't only have the labor force participation rate going up, but you also had the relocation of supply chains into places like China. So you had more workers in the States, which means wages lower. You
Yep.
also had the relocation, which means the labor arbitrage that businesses can have. But right now that's going in the opposite direction, where you might again have blue collar workers demand more and higher wages in exchange for the work that they provide.
There you go. And as you said earlier, it would be nice to see, those jobs being shifted towards the higher skilled laborers. That would be good for us in the US. I believe we have some of the best skilled laborers in the world for sure. All right, Giannis, that was a great episode. Wanted to just clue in a couple things here for the week. We have existing home sales and crude oil inventories on Wednesday. Thursday, we have initial jobless claims and the Philly Fed manufacturing. Giannis, thank you so much for joining me today on Macro Corner, presented by Blue Line Futures.
Thanks so much, Paul. It was a blast being back on the episode, and I look forward to next week.
Absolutely. Absolutely. And don't forget, listeners, the chart book is available in the description of the podcast on bluelinefeatures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@bluelinefeatures for a free trial. Thanks again. I'm Paul Wankmueller, presented by Blue Line Futures. We'll see you guys next week.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.